In the last class, I discussed with you all cost of debt, cost of equity, and cost of preference. If I remember correctly, in debt, I discussed both the models. Cost of debt, where old capital, and cost of debt for new capital, where flotation cost will be there. Cost of preference also I discussed both, and equity also I discussed the dividend growth model and no dividend growth model. Now see, let's solve some more questions on weighted average cost of capital to clear your concepts. A firm has $10 million in equity and $30 million in long-term debt to finance its operation. So there is a company, they have 10 million in equity and 30 million in debt to finance its operations. Firm's beta is 1.125 and risk-free rate is 6% and the expected market return is 14%. The firm issued long-term debt at the market rate of 9%. This is your cost of debt, 9%. Assume the firm is at its optimal capital structure. This is very important. What is optimal capital structure? The capital structure at which cost of funds is lowest, managing the risk overall. Because see, lowest capital structure will happen if you keep on putting more and more debt into it. But if you keep on putting more debt into it, it will become more risky as well. So optimal means the perfect point. Perfect point. The firm's effective income tax rate is 40%. What is the firm's weighted average cost of capital? Now see this. We need two things. Cost of debt, it's already given. They are telling the firm issued at market rate 9%. So interest rate is given. Let's multiply it by 1 minus tax rate. So tax rate is given as 40%. So 9, 1 minus 0.40. This is your cost of debt. Cost of equity, we can calculate using CAPM model, which says RF plus beta multiplied by RM minus so in this case RF is 6%, beta is 1 point and RM is 14%. So it is 14 minus 6. This is your cost of equity. Now let's calculate the weighted average cost of capital. Same format which I discussed in the previous class. So here you have particulars. Here you have amount. Here you have ratio, that is proportion in the capital structure. Here you have cost and final column, column 5 is column 3 into column 4. So they have given, first always we generally write debt. So debt is 30 million. And equity is 10 million. So total is 40 million. So what is the proportion of debt in equity? Sorry, debt in total capital, 30 by 40 into 100%. I guess 75. That is how you calculate. See, ratio means percentage of debt in total capital. This is how you calculate that what is the percentage of debt in the total capital. So debt is 30, total is 40, multiplied with 100, or you can just keep it like this only, 0.75 or 75%. Here it is, of course, 100%, so 0 point. Cost we have already calculated. For debt it's 5 point, and for equity it's multiply 5.4 with 0.75. And this one, add them up. This is your answer. This is your weighted average cost of capital, 7.8%. Now see, even though equity has 15%, debt has 5.44%, but it is more closer towards the debt. Why? Because debt proportion is way higher compared to equity. If equity was higher, it would have been closer to the 15 rather than to 5.4. You have to understand all this because theoretically all this comes. Then let's move ahead. See, this is a very good question. A difficult and a good question. This is what we should solve actually. More of this. See, Williams Inc. is interested in measuring its overall cost of capital. So there is a company called as Williams Inc. They want to measure their overall cost of capital and has gathered the following data. Under the terms described as follows, company can sell unlimited amount, means amount is not a problem, of all instruments. See, first, Williams can raise cash by selling $1,000 par value, 8%, 20-year bonds with annual interest payment. In selling the issue, an average premium of 30 per bond would be received. So my net proceeds will be 1,000 plus 30. And the firm must pay flotation cost of, so we have to use the formula, effective interest rate 1. The after-tax cost of funds is 4.8. They have directly given. Means entire story is nil because they have directly told you what should be the after-tax cost of funds. So in this case, always in exam also when you are reading such lengthy questions and at the end you see that data is already given, note it down in exam also, otherwise you will forget. See, Williams can sell 8% preferred stock. Again, par value of 100 for 105. The cost of issuing and selling the preferred stock is expected to be 5 per share. This they have not told us. We will need to calculate. Williams common stock is currently selling for 100. This is the market price. The firm expects to pay cash dividend of 7 per dollar next year. See, this is D1 because they are telling 7 per share will be paid next year, not this year. So this is D1 and the dividends are expected to remain constant. Constant dividend growth rate, Gordon growth model. The stock will have to be underpriced by $3 per share. What does it mean underpriced? You will have to sell it at less than market price. And flotation costs are expected to amount to, so that means 100 is the market price, 3 to you cannot issue. 100 minus 3 minus 5. Williams expects, okay, dividends are expected to remain constant. Sorry, they are not telling dividend will grow at all. They are telling dividend will be same. No growth model. So it's D1 by P0 only, means D1 by net issue proceed. You don't need G at all because they have not given. Williams expects to have available, so 100,000 of retained earnings is there. Once these retained earnings are exhausted, the firm will use new common stock as the form of common stock equity financing. Always remember, only when your equity, if you have retained earnings, first you will utilize that. Once you have nothing left, then only you will issue new equity stock. ऐसे नहीं होता है कि इक्विटी पड़ा हुआ है फिर भी आप सॉरी रिटेन्ड अर्निंग्स है घर में और बाजार में जाके इक्विटी इशू करोगे, ऐसे नहीं होता है. देन व्हाई आर यू हैविंग इक्विटी, sorry, retained earnings? So you'll have to utilize it. Now see, capital structure is given, preferred. 30% they want of debt. They have directly told you 0.30 debt, 0.20 preferred stock and 0.50 equity. How much Williams needs? Total of 200. What should be the firm's weighted average cost of capital? So see, KD is 4 point KP. So we have preferred. If you remember preferred stock, I told you it's dividend per share. But here it's dividend per share divided by net proceeds. So 8% preferred stock with a par value of 100. So dividend is always payable at par value, right? So in numerator you will have 100 into, and in denominator you will have net issue proceeds. So 100, you will issue it for 105, 5 premium, and flotation cost will be more or less you will receive same one. So in this case, it will be 8 divided by, that is 8% only. I could have directly also done it, but I wanted to show it to you. If in the case premium and this is same, then net issue is 100 only what you are getting. So in that case, it can still be dividend per share because you are getting par value only. Even if flotation cost is given, it is irrelevant to your calculations. You could have done it quickly. And in exam, you should directly do it. You don't need this formula. KE is what I need now. First, let me calculate KR. Now, what is the difference between KR and KE? Remember, in KR, there is no flotation cost. So the formula will be D1, or you can call it D0, whatever, because dividends are constant, right? And you will divide it by current market price only, because you will get the entire money to yourself. So in this case, they are telling me dividends, Williams common stock is currently selling for and expects to pay cash dividend of, and the dividends are expected to remain constant. So dividend is 7 divided by 100. Retained earnings, I need nothing else because I will not have any flotation cost. 7%. For equity, I will have. What will I have for equity? It will be D1 divided by P0, or net issue proceeds. I will use this word. You can call it D0 also because dividends is constant. So D1 is 7, 100. They are telling, what are they telling? Let's see. They are telling stock will have to be underpriced by $3 per share. So 100 minus 3, issue price will be 97. And then there is flotation cost. How much? $5 per share. What is the amount? 0.2 decimals, ma'am. Thank you. That means 7.60%. Don't round it off. Cost of equity will always be higher than cost of. You should make a note here. And remember this, I discussed in the last class also, that whenever there is flotation cost, cost of equity and cost of retained earnings will be different. The moment there is flotation cost, cost of retained earnings and cost of equity will be different. For retained earnings, the cost will be lower because flotation cost you are paying same but you are receiving less. So remember this. Note, if no flotation cost, and this is what is applicable for already existing capital, then KR equals to KE. And if there is flotation cost, then KR will always be less than KE. Because KE, you are paying same amount of dividend even though you are receiving less. Now let's calculate the weighted average. I'll note it down. I'll give you guys time to know. Now let's calculate the weighted average cost of capital. How much they need? $200,000. Particulars, amount, ratio or proportion, cost, and WACC. So first, debt. Debt they are telling is 30%. What is the total amount? See, total amount they have told. I need a total of 200. So total is already given. So how much should be debt? 30% of this, multiply 200K into 30%. That is the amount of debt. Because they are telling, right, that this is the capital structure I want. They are telling also, this is my preferred capital structure. So I will issue 30% of debt. For preferred stock, I will issue 20%. And the cost of preferred stock is 8%. And equity. Now remember, now this is important. What is the amount of equity? Now this is what I was waiting for. See, here they had told William expects to have available $1 lakh of. They already have this. So cost of retained earnings is applicable, not cost of equity. So ratio 0.30, 0.20 and 0. Cost of debt 4. And for retained earnings it is 7%. So 7%. Multiply and tell me. 4.8 into 0.3. 1.42. 1 point. 1.6. 3.5. Add them up. This is your weighted average cost of capital. See, this is how it is calculated for a lengthy question. Generally, if they are asking you weighted average cost of capital, so it's closest to 6.5. If they are asking you in such a lengthy question, they will not ask you to calculate all. That's why they gave you cost of debt. So it is 6.54 or 6.5. Clear? Now note this term. The good thing about weighted average cost of capital is there is no variety. You have to calculate and you have to stick to the pattern. This will be your homework. See, a firm's new financing will be in proportion to the market value of its current financing. So long-term debt 7,000. Forget about thousands. See, 000 is omitted. Preferred stock 1,000. Common stock. The firm bonds are currently selling at 80% of par, generating a market yield of 9%. So effective interest rate is 9%. And company has a tax rate of, so you can calculate cost of debt. The preferred stock is selling at par and pays a 6% dividend. If the stock is selling at par, dividend rate is the amount of preferred stock. Dividend rate and cost of preferred stock is same. So it's 6%. And common stock has a market value. Price is 40. And see, expected to pay a dividend of 1.20 per share. this fiscal year. This, that means just past, not next, D0. Dividend growth is expected to be 10% per year and the firm's flotation costs are negligible. For this, only you will need to calculate common stock. And remember, it is D0, D1. So this year, how much? 1.2. Dividend is expected to grow at 10%. So next year it will be 1.32. Then you can do 1.32 divided by whatever is the price, 40, 40, na? Huh. Plus 0.10. So what will be the cost of equity? I'm just showing it to you how it is supposed to be done. So D1, 1 point, divide by, you always never write the growth in percentage. Always convert it in decimal points. So it is 10%, right? Now tell me, what is 1.32 divided by 40? 0.3, two decimals always. Plus 0.10. So it will be 0. That is 43%. Ma'am, are you sure it should have been 0.03? 133. I was also thinking how it can come 13.3%. Now you will be able to solve. Clear? They are asking again, what is the weighted average? Homework. Same William Singh, see? Now what are they asking? Same question, William Singh. This will be your homework. They are asking now a total of $10 lakh. So remember, in 10 lakh, 30% fine, 20% fine. But if 50%, 5 lakh, 1 lakh is retained earnings, cost is different. And 4 lakh will be cost of equity, cost will be different. Homework. These are your options. 6.8, 4.8, 6.5 and 27.4. Previous question also options were already there, na? It was there, right? See, again, following is an excerpt from Albion Corporation's balance sheet. Long-term debt, 9% interest rate, 30 million. That is 3 crores. Preferred stock, 1 lakh shares, 12%. Dividend, 10 million, 1 crore. 12% dividend, that is your cost of preference. 9%. Common stock, they have told how many shares are outstanding. 5 million. Albion bonds are currently trading at this price. See, price of bond is given. Reflecting the yield to maturity of, this is your effective interest rate. Yield to maturity, market rate, whatever we used in valuation of bonds. Preferred stock is trading at 125. Common stock is selling at 16 per share. And treasurer estimates they have given you. Cost of equity is how much? 17%. So I only need to calculate cost of preference. So see, dividend will be how much? Per share, it is, par value is 100. How do I calculate that? See, 1 crore, 10 million is the total par value and number of shares, 1 lakh. So par value, 1 crore divided by 1 lakh. 1 crore divided by 1 lakh, not 10 lakh divided by 1 lakh. Into 12%. And this is your preferred stock market price divided by 125. Always multiply it with 100 per 100. 9.6, whatever, two decimals. So this will be your cost of preference. Now you can calculate. Already everything is given. So these are nothing. You just will need to calculate cost of debt, preference, equity using what I have taught you already. Table, question is done. Again, see this Williams question. What are they asking now? They are asking what is the cost of funds from retained earnings. We have calculated now. This is already calculated. In the previous question, I did calculate, right? In the second question, cost of funds from retained earnings was 7%. Let's have a break of 5-10 minutes and we'll continue. We have discussed this, na? While its new financing will be in proportionate to the market value of its present financing. What is present financing? Same. Long-term debt, 7,000. Preferred stock, 1,000. Common stock, 7,000. You will have to add it up and then calculate the weight. Firm's bonds are currently selling at 80% of, generating a market yield of, this is your effective interest rate. And the corporation has a tax rate of, this is again your relevant factor. Preferred stock is selling at its par value and pays a 6% dividend. KP is given directly. Common stock, they are telling market value of 40. Dividend again, see 1.2 per share, but this fiscal year. What is dividend growth? You will have to calculate KE. D1 by P0 plus G. I think I did it. What are they asking? Weighted average cost of capital. That's it. Homework. Then this will also be your homework. See, a corporation is preparing to evaluate the capital expenditure proposals for the coming year. Okay. Because the firm employs DCF, discounted cash flow, cost of capital has to be estimated. Following information is given. See, market price they are telling is 50 price. Dividend next year is expected to be 2.5. This is already D1. You don't need to adjust the growth rate. And expected growth in dividend is 10. So 2.5 by 50 plus 0.10, that will give it to you. This is D1, not D0. This is the word you have to be very careful about next year or this year. New bonds can be issued at face value with a 13%. This is your cost of debt. Pre-tax. Current capital structure is what? 40% debt and 60%. This is optimal. So you will continue with this only. What is anticipated earnings? Okay, retained earnings are 3 million. Retained earnings are 3 million, 30 lakh dollars. The firm has a 40% marginal tax rate. If the firm must have a 10% flotation cost is always calculated on price or par value. But this is equity share, so we will assume price only. If it was preferred stock, I would have assumed, or debt, if I would have assumed par. So this is 50. 10% of this. They are asking what is the cost of new common stock. Clear? Homework. No, this is something else. Again, this will be your homework, but first, understand the question. Vivid Inc. has determined that it needs $10 million. $10 million means 1 crore of funding to expand its operations in a foreign country. Its capital structure consists of what? 10% long-term, 20% preferred, 40% equity and 30% retained earnings. Vivid issued new debt and collected 40,000 of proceeds. What is the yearly interest rate? 12%. They have not told us anything, right? Flotation cost. So effective interest rate is 12% only. Pre-tax. Always remember, you have to multiply it with tax rate. Cost of retained earnings directly given, 13 point, and cost of new common stock directly given. They have also told Vivid can also sell 200 par value preferred stock that pays a dividend 15% and has a $10 flotation cost. This is the only thing you will have to calculate, KP, dividend amount divided by net issue proceeds. And see, they are asking what is the weighted average cost of capital. They are asking you to round it off to 3 decimal places. Clear? Homework. Most of these questions are pretty simple. Then, same Williams Inc. What is now they are asking? They are asking cost of funds from sale of, I think we had calculated KE in that question. 7 point. Generally, they ask only a part, because otherwise it will become too lengthy for an MCQ. In CA or ACCA, they may ask the entire thing. Same question, I think. This will be your homework, straightforward. They are just asking cost of capital for retained earnings. Remember, for retained earnings, there is no concept of flotation cost. Remember this very, very clearly. Even though they have given flotation cost, you will have to ignore it because they are asking retained earnings. What is the weighted average cost of capital? Homework. So that's it for weighted average cost of capital. Thank you.